We're going to get a rally between now and the end of the year in the stock market, the so-called Santa Claus rally, but it is a sucker's rally that will not last and should be sold. In contrast, what's going on in the gold market and in the gold stocks, this is not a sucker's rally. This is a new bull market that nobody is talking about, and it's going to coincide with a new bear market in the U.S. dollar.
In today's video, Peter gives a warning that the 2008 crisis was just a prelude to a larger sovereign debt crisis in the United States that may lead to a collapse of the U.S. dollar. Before listening to him, please ensure to smash the like button and subscribe to the channel.
Yesterday morning, the Labor Department released the highly anticipated November non-farm payroll report, otherwise known as the jobs report. And I think a lot of investors were anticipating that we would finally get a miss in the number of jobs created. The consensus was for 200,000 jobs created in November, and I think a lot of people on the street were looking for a lower number, and for good reason. Lots of companies had been announcing layoffs, particularly technology companies. In fact, yesterday, the Challenger job cut report came out, and it showed 76,835 job losses in November. That is a huge number. It's more than double the number of job cuts announced the prior month, and more than 5 times as many job cuts as were announced in November of 2021. And if you get the continuing unemployment claims that were released on Thursday as well, they hit a new 10-month high. So I think there was a lot of reason that investors were looking for a weak number. In fact, I think that's part of the reason that we had the strength in the stock market earlier in the week and the weakness in the U.S. dollar and the continued strength in gold. It was partially on the anticipation of a weak jobs number, which would have taken some of the pressure off the Fed to hike rates more or keep rates higher for longer, because a lot of people incorrectly still believe that inflation is caused by too many people working, and that if we only have more unemployment, we'll have less inflation. Now, that isn't true, but that's what investors believe. But contrary to those expectations, we actually got yet another stronger than expected non-farm payrolls report, at least the way investors were reacting to it. In fact, this is the 7th month in a row where the jobs numbers have come out stronger than expected. And as a matter of fact, this report even included an upward revision to the prior month, which was originally reported as plus 261,000, which was a beat. Well, now it's a bigger beat because that was revised to 284,000. But the November number came in at plus 263,000 jobs. But probably what the markets also reacted to, in addition to that bigger than expected number, was the larger than expected increase in average hourly earnings, which were expected to rise 0.3, which would have been a smaller rise than the 0.4, which was originally reported for the increase in the prior month. Well, that number was revised to up 0.5, and the November number came out at 0.6, double what had been estimated, and actually 50% above the upper end of the range of estimates, which went from a low of 0.3 to a high of 0.4. And year over year, average hourly earnings, which were expected to rise by 4.6, and which would have been a slight reduction from the up 4.7 from the prior month. Instead, we revised the prior month to up 4.9, and November, instead of going down, it rose to up 5.1%. So a big increase in average hourly earnings, both on the month and year over year. And that sent the chill through the market that the Fed would now have to be tighter with its monetary policy because inflation was getting worse due to increased pressure from rising wages. Now, average hours worked actually declined a bit from 34.5 to 34.4, but still, workers got paid more for every hour that they did work. And that, of course, adds to the upward pressure on costs that their employers are already having to deal with. But in reality, it's not rising wages that are going to cause higher inflation. It is higher inflation that is causing wages to rise. Wages are just a price, the price of labor, just like every other price, and prices are going up because of inflation. Rising prices don't cause inflation, they result from inflation. And what this jobs report indicates is higher inflation. Inflation is pushing up wages. Now, they're not going up as much as prices because prices are still up about 8% year over year, and that's the official increase. The actual increase is probably twice that amount. And so real earnings are collapsing. And that is the real story behind this payrolls number. Because contrary to the way it's being described by the media, it is not a strong report. In fact, I read one news story that described the U.S. labor market as being hot. Because of this report, we had a red-hot labor market, according to the media. Well, the labor market is not hot. It's actually cool. In fact, it's pretty much ice cold. And that's what the non-farm payroll report actually reveals if you're smart enough to look beneath the surface. And by the way, you don't have to look very deep. Just looking at the nature of the jobs that were created, they were almost all service sector jobs. Only 14,000 manufacturing jobs were added. That's well below the 20,000 that were expected, and even more below the 36,000 that were added in the prior month. Remember, the problem with these service sector jobs, and a lot of them were in government, they were in healthcare, they were in leisure and hospitality, but these jobs don't produce goods. But the people who have these jobs buy goods. Well, if they're buying goods that they didn't help produce, where are these goods coming from? They're going to come from abroad. These jobs that are being added are simply going to add to the trade deficit as people who have non-productive service sector jobs take their paychecks and buy goods that they didn't help produce. ISM manufacturing index for November sinking below 50. It came out at 49. The prior month, it was at 50.2. The expectation was for 49.9. But again, anything below 50 indicates contraction. And this is the first time that that index has been below 50 since May of 2020. What was going on in May of 2020? That was the depth of the COVID lockdowns. And so the manufacturing sector is as weak right now as it was in the worst part of the COVID pandemic. What does that tell you about the health of the economy and where the economy is likely headed in 2023? But I want to move on and talk about the market's reaction to what was heralded as a much stronger than expected